Welcome everyone to our webinar on selling a business, how to successfully complete your business sale. My name is Bianca Reynolds and I am a practice leader in LegalVision's corporate team. Before we begin, a couple of quick housekeeping items. So you'll receive the recording and the slides in your email. Please submit your questions in the Q&A and I'll answer them at the end of the session. And we'd appreciate it if you could complete the feedback survey after the webinar as well. So for the next 48 hours, you're eligible for a free consultation with LegalVision to discuss how we can help your business. So if you provide your contact details in the survey at the end of the webinar, we can then reach out to you. So today we'll be discussing preparing for sale, how to structure the transaction, negotiating and documenting the transaction, managing the completion process. And then at the end of the webinar, I'll answer some of your questions. So please use the chat function throughout the webinar. So now I'll begin by speaking about preparing your business for sale. So, when you're planning to sell your business, you need to think about whether or not it's really the right time to sell. So, some of the factors that can influence your decision are things like market conditions, trends for your industry, the economy as a whole, and of course, the financial performance of your business, particularly over the past kind of 2 to 3 years and then also the financial projections as well. So once you have decided that it is the right time for you, that's when you then figure out what your purchase price is going to be. So the price you can get for your business will depend on if its financial performance, has been improving and growing, maintaining at a steady pace, or declining. And of course, if you can sell your business towards the end of a growth period, that will help you achieve a higher price. And on the other hand, if your business is in financial decline, if you have high debt and liabilities, then it can be more difficult to get, a higher price. So there are many components that go into making up a business and how you would value it, such as goodwill, assets, and liabilities. And so I recommend that you obtain advice from, an accountant, a valuer, or even a business broker, and they can assist you with correctly valuing your business to achieve the best possible asking price for you. So the next step is then to identify potential buyers. So engaging a business broker could assist you to more easily connect with potential buyers. You should find one that has experience selling businesses in your particular industry, and they can tap into their network. They might often have a list of buyers who are interested in purchasing different businesses in that industry. You can otherwise advertise your business for sale online, such as via Seek Business. You might even have industry contacts you can reach out to and see if there's interest from the market. You might have competitors who might want to acquire your business, or even employees you've been working with who want to kind of take over ownership from you. So once you've decided that it's time to sell and you've figured out an appropriate price, it's then time to start getting your business in order so that it's ready for the due diligence process. So the first step is really to know the strengths and weaknesses of your business and address them as early on as possible. So you should do an audit of the documentation you have in place in your business to understand where there are any gaps that should be addressed. So for example, you should make sure that your financial statements are in order, your key legal documents are in order as well. Things like having signed and compliant employment contracts in place for your employees, You'll also need written contracts with, material customers and suppliers. If you generally only work with handshake agreements, then that could actually devalue your business as it might be more difficult to transfer those arrangements to an incoming buyer. So it's also important to start thinking about the other key components of your business, and whether you have everything you need in place. So, for example, do you have a registered business name that you can transfer to a buyer? Do you have a registered trademark to protect that name? Is your equipment and other physical assets, are they working for their age? If you operate from a physical location, so an office or a shop front, do you have a lease in place, and how long is the term left on the lease? So these are all questions to address, before you take the next step to find a buyer and proceed with the transaction. So, once you've started preparing for sale, you've then found a potential buyer. Normally, the next step in the transaction process is for you and the buyer to start entering into the due diligence phase. So, the first step is to enter into a non disclosure agreement, or also called a confidentiality agreement. Um, and that will help to keep your business information confidential and protected as you start entering into those discussions with the buyer. So the due diligence process can kick off before or after a heads of agreement or a sale agreement is signed, but in either case, it's really the process by which the buyer is investigating your business, to understand, is it worth the price that you're asking for? Are there any liabilities or risks that the buyer needs to be aware of in deciding whether to go ahead with the purchase? So the buyer will first then request information from you. They'll often send you a list of the records and information and documents that they want to review and inspect. So things like, financial statements, material contracts. You'll then send them that information via email or via a data room, which is really just like a online document platform like Dropbox or Google Drive, where you can upload documents. And it might also have function you and the buyer can ask and respond to questions through the platform. So the buyer and their due diligence team, which will usually be their accountant and maybe their lawyer, they'll review the information you've provided. They'll then start asking you some questions about that information. So this is called a request for information or RFI process. And as I mentioned, the questions could be submitted via the data room, or it could just be, sent by email or through exchanging a spreadsheet with questions and answers. So you'll then, review those questions. You might seek advice from your own lawyer or accountant on how to respond, and then you'll provide your responses. So the buyer's legal team and their accounting team, will then prepare reports for them to consider about the information you've provided. The buyer will consider that information and the reports, and then they'll really make an assessment about, whether or not they still intend to go ahead with the purchase, whether they might want to try and renegotiate the price based on their investigation, or whether they might want to then request for you to provide specific warranties and indemnities, to help limit any risk that they've identified in proceeding with the purchase. So, in addition to preparing for sale, it's important to really obtain the right legal, tax and financial advice, not just on the aspects of preparing for sale, but also in determining how to structure the transaction. So it's best to get advice from those advisors as early on as possible in the process to help set you up for success. So really before any kind of term sheet or heads of agreement is signed, which I'll go through a bit later in the session today. So when you're thinking about structuring the transaction, there are usually two main ways to go about conducting a sale of your business. So if you operate via a company structure, then you could look at selling the shares in your company to the buyer, or you can actually then sell the assets which comprise the business. So if you operate with a company, the company owns those assets and it would then transfer those assets to the buyer. If you operate as a sole trader, you yourself own those assets, so you would be transferring them to the buyer. So there are pros and cons of each of these two approaches outlined on the slides. So with a share sale, in this type of transaction, the buyer acquires the whole company. So all of the client, supplier, and employment contracts still stay with the company. So there can be less effort and risk associated with obtaining consents from those third parties or ensuring that those clients or employees stay with the company. And there may also be tax advantages to structuring it that way as well. For example, CGT discounts if you've held your shares for over 12 months. So, it's best to also discuss it with a tax advisor to see which structure will be best for you from a tax perspective. Um, and on the other hand, the share sale can have some disadvantages. So, because the buyer would be acquiring the entire company, they would be taking on and inheriting all of the historical liabilities that sit within it. So, all of the skeletons in the closet, essentially. So, to protect against those liabilities, the buyer may ask you to provide pretty extensive warranties, which could be for an extended time. They might also do, more comprehensive and involved due diligence because of that. They might also want you to provide a guarantee to help as security for any warranties that you're providing. And if you do own your shares personally and you're providing the warranties personally, there can be a risk there to your personal assets if there was a claim against you. So moving on to an asset sale. So some of the pros for an asset sale are that given the buyer is acquiring certain assets, rather than the entire company, they'll likely request fewer warranties and indemnities when compared to a share sale. And you can also agree with the buyer for certain assets to be excluded, which can be both for your benefit and their benefit. Um, on the other hand, some of the cons can be that because everything needs to actually be transferred over to them, so things like contracts, assets, you might actually need to then get consent from those third parties to transfer those contracts over to the buyer. And that can be a time-consuming process. You'll also likely need to obtain a release of any security interests that are registered over any assets. If you've got equipment leases, for example. And in an asset sale, there are liabilities that will still stay with you as the seller, if you continue to own the company. And once the sale has been completed, you'll still have ownership of that company. So then you need to decide what you want to do with it, whether you need to wind it up or use it for something else. So there can be, additional processes and costs to figure that out afterwards. So as you can see, there are advantages and disadvantages to both structures. There are ways to, mitigate the risks associated with both types of transactions. And yeah, just reiterate, it's really important to get that legal and commercial and financial advice early on so you can choose the most appropriate structure that's best for you from a holistic point of view. Okay, so once you've decided on how you want to structure the transaction, you'll then want to consider how the buyer is actually going to pay you the purchase price and when. So there are a number of ways to do this. And generally the sale agreement will set out, of course, what the purchase price amount is, but then also the ways that it's going to be paid to you. So you can structure the payment methods through a number of these ways on the slides. So the ones we normally see would be, an upfront payment, deferred payments, earnouts, and vendor finance. So I'll go through each of those now. So if part of the purchase price is to be paid up front, so it means that, part of the total purchase price is payable by the buyer to you on the completion date of the sale. I'll go through the completion process a bit later on in this session, but completion is really the point in time at which legal ownership of the assets or the shares transfers from you to the buyer. But if part of the purchase price is to be paid as a deferred payment, this means that a portion of the total purchase price is payable then after that completion date. So the obligation on the buyer to pay a deferred payment could be, subject to certain conditions being met, or it might just be simply a delayed payment, that's payable 6 months' time, for example. Another way to structure part of the purchase price is to use an earnout mechanism. So in general terms, an earnout refers to a pricing structure where a portion of the payment is earned by you based on certain performance milestones after the buyer's actually taken over ownership of the business. So for example, it could be that if the business makes, X revenue within 6 months, the payment will be based on Y. So earn-out payments can be for cash, or sometimes we might see that the buyer might actually issue with shares in their company as payments. So it can be structured quite a different number of ways. And finally, the purchase price could be payable by way of a vendor finance arrangement. So vendor finance happens when you as the seller effectively fund part of the purchase price. So in this situation, the way that it works would be the buyer would usually pay a portion of the purchase price upfront on completion, and then meet the balance over an agreed period of time with regular repayments to you, often that accrue interest. So it's really repayable as a loan. So there are, various conditions that can be addressed before entering into that kind of arrangement. Often there are additional documents that are needed. So I do recommend you get legal advice if you're thinking about that kind of payment structure. And then it's worth mentioning here that with each of these payment methods I've outlined, it's also possible for there to be the payment of a deposit by the buyer. So it's quite common to see a 10% deposit payable, and that might be paid on the signing of the sale agreement, or it could be paid earlier on the signing of the initial heads of agreement or term sheet, for example. And then it would, of course, be subtracted off any remaining purchase price that's owing. Okay, so I'll now talk through some of the tips on how to negotiate and document the transaction, once you've figured out the structure and the purchase price arrangements. So it's first really important to understand the buyer's motivations and their concerns. So it can help to think about the strengths and weaknesses of your business that might be deal breakers for the buyer. So as discussed earlier, the buyer's concerns will be driven by the outcome of their due diligence. So you should have a think about where the material risks in your business lie. For example, is it not having written customer contracts? Or have you been in a dispute with any employees? Have you got any tax liabilities? So if you follow those earlier recommendations about preparing for the sale, you can hopefully address some of those risks early on before you even begin negotiating with the buyer. The second part of this is thinking about the buyer's motivations for wanting to acquire your business. So, is it to expand their existing customer base, or they want to acquire a specific customer relationship? Once you have a better idea of their reasons for wanting to buy your business, you can then focus on ways of providing comfort to them to get at the heart of those points. So this could include, providing specific warranties and indemnities about those things that you're happy to provide and that you know will be of material importance to the buyer. So when it comes time to actually negotiate the transaction, some additional things to think about are the first being the bargaining power between you and the buyer, as that can be a significant factor in determining the terms of the sale agreement. So for example, if you're looking to sell to, a larger enterprise or an ASX listed company, you might have less ability to negotiate certain terms than if they were a business more of a similar size to you. Another factor to consider is the timing of the sale. If you're desperate to sell because you're moving or you're starting another venture and the clock is ticking, that can impact on your negotiating tactics, and you really just want to focus on material issues. But if you don't have that kind of time pressure, then you might have more time to spend negotiating, and so then you can achieve more favorable terms. And the final point here is to think about your risk tolerance and the buyer's risk tolerance. So thinking about material issues and your key risk factors to address those as much as possible while giving the buyer wins on, matters that are less important to you. So now I'll talk through some of the key transaction documents, that you'll encounter throughout this process. So as mentioned earlier, a non-disclosure agreement, it's important you enter into that with the buyers early on in your discussions with them as possible to protect your business information. The second document listed here is a heads of agreement. So this could also be called a letter of intent or a term sheet, non-binding, indicative offer, among many other names. But really the essential purpose of this document is so that you and the buyer can agree on the key commercial terms of the transaction up front, mostly so that no one wastes any time or money trying to get through a deal that has major commercial issues. Um, we've dealt with a lot of transactions where, they've kind of moved too quickly beyond this initial stage and straight into due diligence and the sale agreement. While things like the purchase price or even the structure hadn't been agreed or sorted out. And as you can imagine, that does create a number of issues and can draw out the process even longer if you're trying to sort out all of those key commercial things as well as actually negotiate the legal terms of the documents. And the final document that I'd like to talk about is the sale agreement. So this is the legally binding document, and will generally be either a share sale agreement or a business asset sale agreement. So a lawyer who has experience in transactions will be best placed to prepare an appropriate document for you that really protects, your interest and includes some of these key clauses that I've outlined on the slide. So things like conditions precedent, which are conditions that have to be satisfied in order for the sale to go ahead, completion obligations, warranties, indemnities, and post-completion obligations. They'll also ensure that the agreement is tailored to you, sets out the particulars of the sale, and is really drafted specifically for your circumstances. So moving on, I'll now take us through the completion process and then what to expect, on the day of actual completion. So really, what is completion, I guess, is that first question. So when we talk about completion, it's important to remember that completion and settlement are really just interchangeable terms that mean the same thing. So it's that point in time where the ownership of the business assets or the shares change from you to the buyer. So this is usually, but not always, after the date that you sign the sale agreement. So there'd usually be a point in time, a period of time in between signing and the date that the buyer actually takes over ownership. So The sale agreement will typically set out a target date for completion and the latest date that completion can occur before you or the buyer could walk away and the agreement terminates. So usually completion will occur on the later of that target date and the date that all of the conditions precedent that have to be satisfied have been satisfied. So for example, if you put in your contract, I want to complete on the 30th of November, but if things aren't ready by that date, the latest date that things need to be ready by could be, the 31st of December, for example. So as I mentioned, the conditions precedent are essential things that have to be satisfied before the buyer can take over ownership. And these will really depend on the nature of your business, but they can include things like the buyer being satisfied with their due diligence, the buyer obtaining finance to pay the purchase price, you obtaining consent from the landlord to transfer your lease to the buyer, um, if there's any registered security interests, if you've got business loans, those needing to be released, things like that that are really material. And so the target completion date that's put in the sale agreement, in our experience, can often be missed because some of these material conditions have not been checked off by that date. So when you are preparing for the sale, it's really important that you plan for delays and be flexible, particularly if you're relying on third parties, like landlords, to get back to you and to arrange for certain things to happen. So definitely don't assume that completion will occur on that target date and, book a cruise the next day or anything. Give yourselves enough time of a buffer in case you need it. Sorry, in the lead up to completion, once the sale agreement is signed, it's important that you then put your project management hat on, essentially, as you'll need, to communicate with the buyer regularly, to organize things. And at this point, there are really only a limited number of things that will prevent completion from occurring, once the conditions precedent are satisfied. So it will then be time that, you start telling your employees, your clients or suppliers or other key stakeholders that you are now selling your business. So you'll have to work through, managing those business relationships to ensure you maintain the goodwill of the business. Enter into discussions with your employees about what the sale of the business means for them, if they're receiving new offers of employment from the buyer, for example. You'll then need to start reaching out to those customers, suppliers, and your landlord if that's relevant to potentially get their consent to actually transfer any contracts to the buyer. So with the conditions precedent, they're usually for the benefit of the buyer. So the buyer's lawyers will often kind of manage the completion process in that sense. So they will often prepare a completion checklist, and that will set out, all the conditions precedent and the deliverables that are mentioned in the sale agreement that need to be ticked off in order for completion to happen. Um, so as soon as the sale agreement is signed, and even beforehand, it's really your job as the seller, to work with your advisors to start addressing each of those deliverables so that you can make sure that they're satisfied, as soon as possible and hopefully by that initial date. So if you are, worried that there'll be delays or you'll be unable to satisfy some of those things, it's really important that you speak to your advisors early on and the buyer, so that you can work out a solution. Do you need to agree to extend the target completion day, or are there other things that you might need to figure out? And as completion gets closer, you'll usually have daily check-ins with your advisors, your accountant and your lawyer, potentially with the buyer as well, as you start trying to tick all these things off so that you're ready for that handover date. So on the day of completion, most of the work is usually already done by this point in time. So this will be really the day where if there are any other ancillary documents that need to be provided. So for example, signed employment contracts with the buyer for key employees. Those things will usually then be provided to the buyer on the day of completion, as usually most of the conditions precedent would have been sorted out before this day. So there might be a completion call on this day, and that will be between you, your lawyer, the buyer, and their lawyer, or just between each of your lawyers, where they'll actually go through that checklist to make sure that everything has been ticked off and that you're kind of ready to formally complete the sale. So once you've both gone through everything, you're both satisfied. So you and the buyer, you're both satisfied that everything's been ticked off. The buyer will then pay you any upfront payment that's due on that day. And you will then need to deliver, any other remaining documents or items to them. So, records of the business. If you've got keys to a premises, you'll need to physically meet up with them to hand those over. Give them passwords to social media accounts, things like that if you haven't already done those things. Okay, so that concludes the main part of our webinar today. So you might find this publication useful, which is about our How to Sell Your Business guide, which talks through some of the points I've raised today and some additional points. You might also be interested in our upcoming event. So we have another webinar next week on the 5 essential contracts that every tech company needs. So that might be useful for you if you're in that space and you're planning to sell down the track. And so while you start submitting your questions that I'll answer shortly, I'll just take a minute to talk you through our membership. So by becoming a LegalVision member, your business gets unlimited access to our full team of over 100 specialist lawyers for all of your day-to-day business as usual legal needs. So it's really like having your own in-house legal counsel or lawyer on speed dial, for a fraction of the usual cost. So our team can assist you with unlimited document drafting and reviews of business contracts, unlimited legal advice consultations, unlimited, domestic trademark registrations, and so much more. So as a LegalVision member, you don't ever have to worry about the cost of lawyers again. It's really thinking about it as your own in-house lawyer, and will take care of all of your business as usual legal work, so you can really go back to focusing on actually running your business. And if you are in-house counsel, we do offer a dedicated service to actually help in-house teams manage high volume business as usual legal needs. So if you want to learn more about how our membership and our desk extension for in-house counselors can help you, please request the free consultation when the survey appears at the end of the webinar, and our team can certainly go through it with you in more detail. Okay, so now I'll answer some of your questions. So let me just see, we've had quite a few come through here, which is fantastic. So the first question here, so how to present a sole practitioner professional business for sale, with some concerns about key person risk. So I guess in that sense, it's like one thing you could think about in terms of how you structure the transaction is whether you're actually willing to provide assistance to the buyer after the sale. So working in the business for a certain period of time to help with the transition process. But also thinking about initially, have you got key employees that you might, or could you bring on a key employee to help kind of build and develop it so that all of the goodwill isn't just retained in you personally. So a few things to think about there, but there's definitely ways that you can work with your advisors to help structure it to deal with that situation. So how does the sale of a business affect existing contracts with third parties, generally speaking? So this depends on, I guess, the structure of the transactions, whether it's a share sale or an asset sale. So if we're just talking about, a business asset sale, those contracts do need to actually be transferred over to the buyer. So depending on the terms of those contracts, you might actually need consent, of that third party in order to transfer it. And normally that would be done by way of like a deed of novation or a deed of assignment that your legal advisor can help prepare for you. And that would need to be signed by you, the buyer, and the third party to actually transfer that contract across. Whereas if it's a share sale, because the contract stays with the company, um, the terms of that contract may instead require you to get what we would call change of control consent, where nothing's actually transferred, but you might still need consent of that third party so that they know that you are actually selling majority ownership of your business to someone else. Okay, so how best to protect the seller for legal claims from the buyer post-settlement? So the best way to do this, I guess, is to do all of the preparation work that I've gone through as well, so that you are aware of what those risks might be for you, and to then work with your lawyer to make sure that in the sale agreement, if you're required to provide warranties to the buyer, so promises about the business, that you're, I guess, first comfortable making those promises that they are true and correct. But then you can actually include clauses within the sale agreement to help limit your liability, providing those warranties. So, for example, you can have clauses that set out that, you're only liable to the value of the purchase price, so that if they sue you, at least you'll never be liable for more than what they might pay you for to buy your business. And then also you can include things like time limitations. So they're only able to make a claim within 12 months of completion, for example. So there are ways to help kind of address and help limit your liability from claims. Um, okay, so we've got a disability services proprietary limited business, which is a company trustee for a family discretionary trust. How do we go about selling the business? Um, so I guess with this one, if you, more generally, if you operate your business through a family trust, discretionary trust structure, then you will actually need to do a business sale to transfer the assets over to the buyer. So you wouldn't be able to do any kind of share sale because the business assets are actually held uh, for the benefit of the trust, not just in your kind of corporate trustee company. So it would need to be transferred over, but that's completely fine. You can definitely do that. The other thing to think about is if you have, for example, if you're registered with the NDIS, you can't actually transfer registration. So that's something to think about if the buyer might actually need their own registration. We do have an NDIS specialist team at LegalVision. So if that's relevant for you, then please request a free consultation and we might be able to assist further with that inquiry specifically. Um, okay, so let me have a look and see some more here. So are there some good electronic data rooms that you would recommend for the sale for small business sales? I mean, in terms of recommendations, I mean, a common one that's used is Ansarada, which is a bit um, of a system that we see used in larger transactions. Um, Otherwise, off the top of my head, I can't think of any others, but otherwise, things like Dropbox, Google Drive can also work. But yeah, I'll have a think and see if there's anything else that we might be able to give you some more information after the call. Okay, let's see. So tell me some details about selling part of your business shares, less than 50% versus a controlling interest. Okay, so with this process, this is a bit different, I suppose. So in this situation, if you're selling some of your shares to a buyer, but you're actually going to you're not selling your entire interest, so you're going to remain with the business and the buyer's kind of just coming into the business. Um, in that situation, you'd be wanting to think about, how you're going to be working with the buyer moving forward after the sale. Um, how are you going to make decisions with them in terms of, are you both going to be directors of the company? Um, so you definitely need to have a shareholders agreement in place as part of that process. So you would still need that share sale agreement, but you need an additional shareholders agreement. And it's just a bit of a different mindset because you're not completely exiting the business. You're going to stay with the business moving forward. Um, okay, so what are some examples of some warranties and indemnities that a prospective buyer might request from a seller? So with the warranties, so as I mentioned, they're really promises and representations that you're making to the buyer about the business. So things like, the plant and equipment is in good working order. Um, so, you're saying to them that that statement is true as at the completion date. So if after completion, um, they uncover that that actually wasn't true at completion, if they come into the premises and actually, the fridge was already broken, then they could make a claim against you because that statement wasn't true, and they would suffer a loss as a result of that because they now have to pay to replace that fridge, and they've just paid you all this money to buy equipment that they thought was working. Um, in terms of indemnities, so um, these are really, I guess, promises that you're making to the buyer to reimburse them for a specific liability. Um, so it depends on the type of transaction, but if there's like if it's a share sale and there's tax liabilities, for example, you promising to reimburse them if they suffer, if they have to pay any costs as a result of those liabilities that are really your responsibility. Um, yeah, so it just depends on the transaction, but hopefully those are a couple of examples for you. Um, Okay, let's see. So, in terms of things like valuing goodwill, there's a few questions come through about that. I would really recommend having a chat to your accountant as it's really um, best placed for them to kind of advise you on what might be an appropriate valuation methodology. Or if it's not something that, they're able to assist with, there are, professional business valuers that can help with that, as it can be, they do have specific processes and methods they can use to actually value goodwill and things like intellectual property, which, aren't tangible assets, so can be a bit more tricky to figure out. So if that's a big part of the value of your business, then I definitely recommend engaging one of those specialists to help you figure that out. Um, Okay, let's see. Um, so I think those are probably, we might have time for one more question. So there's a lot of services like flipper.com that can help people sell online businesses. What cautions would you give about going that way? Um, so I guess I would still say that it's still really important that you have a legally binding sale agreement in place. I'm not across the ins and outs of if Flipper or if they'll actually um, provide that kind of document as part of the arrangement for selling through there. But either way, I would still definitely recommend you either get a suitable document drafted and tailored to that specific arrangement, or have a legal advisor review kind of the document that's available for you to use on that platform. Um, I think, yeah, definitely just want to make sure, I guess, if Flipper or Theta are offering that an escrow service, then that can, I guess, help to reduce some of the risk, to make sure that, you're paying that money and it's going to an appropriate person who is actually selling that business. But yeah, definitely having a legally binding agreement in place so that it's really clear what's going to be transferred to you, when that transfer is going to happen, and also, that way you have recourse against the other side. Okay, I think that's all we have time for today. So I'm sorry if I wasn't able to answer your questions. So definitely please, submit your details at the survey at the end, and we can then help you to go through some of the questions that I wasn't able to get to today. And then you can also use that to learn more about, the membership offering, and how we can help you further. And so while this is a free webinar, we really value your feedback. So please complete the survey at the end. And thank you again for joining us today.